Good evening, everyone, and thank you for coming tonight. My name is Eamon Gebre, Head of Wealth Advisory here at Sarwa. Today, we're going to be talking about the habits of successful investors. We hope this to be an interactive session. We are going to be fielding questions towards the end of the event. We might also reach out and ask you questions in the middle of the presentation as well. A little bit about myself. Again, my name is Eamon Gebre. I've had the privilege of working with Sarwa, just celebrated the 2-year mark now. I've spent 12 years in the region working with organizations such as HSBC. And in the past, I spent another 10 years working for an organization called TD Canada Trust. My entire career has always been working with individuals like yourself, giving guidance and support to help you achieve your financial goals. And hopefully, I can share some of the wisdom with you today. I'm joined alongside my team, the Wealth Advisory team. I have here Akshay Iyer, who's one of our wealth associates, as well as Mark Mudapper, who's our lead investment and our lead investor with us at Sarwa. Maybe I'll let you guys introduce yourselves.
Hello, everyone. My name is Mark. I am the investment lead at Sarwa, as Ayman mentioned. I've been here for 2.5 years almost. Came straight from Canada, and I've been part of the operations team initially and moved over to wealth afterwards. And I'm glad to be here with you today.
Perfect. Thanks, Mark. Thank you, everyone, for joining. My name is Akshay. I'm part of the advisory team as well. I actually have a background in banking as well as private wealth management. So I started my career at the Canadian Imperial Bank of Commerce in Canada. It's also where I was educated. And following that, I worked for a British private wealth management company. So I've actually been with Sarwa for the past year now and look really passionate about what we're doing here in terms of democratizing investing, but really bringing across, a much more flexible, transparent platform to this region. So thank you very much.
We have another member of our team who unfortunately wasn't able to physically make it here today, but he did prepare a video for one section of our presentation. His name is Faisal Abdul Shakur, and he'll be joining us at a later point in the presentation. Now, what are we going to be talking about today? We're going to be diving into the conversations that we have day to day with our clients and highlighting some of the pitfalls that some of our clients go through and the opportunities that they have to be able to overcome them. We're going to get very granular about investment habits, behaviors, styles, and different approaches to investing to highlight to you what is the best approach to take to ensure your financial success. Now, it goes without saying, anything that we talk about today, should not be interpreted as one-on-one financial advice. We have, scenarios and personas that are created for the presentation today, but you might find yourself relating, it might speak to you, but at the end of the day, your circumstances are unique to you. Have a conversation with an advisor, whether it be your own or one of our members of our team, and to receive better guidance on what you should do to achieve your financial goals. And of course, it goes without saying, we don't have a crystal ball. So if you get any questions today that talk about what's going to happen in the market tonight or 2 years from now, 5 years from now, it would be very difficult for us to answer it in a very accurate way. Market can be irrational at times, but there are strategies that you can take to even out the odds. So, as an overview, we're going to start with highlighting the financial life cycle. For some of you wonder what is that? It's the typical journey that most of us have either already gone through or are anticipating to go through over the next 20 to 30 years of our lives. Number two, we're going to highlight the challenges that we typically face as retail investors, followed by talking about how to overcome those challenges by just following the key pillars of financial success. Next, we're going to start diving into the investors that we talk to on a daily basis, their investment behaviors, their habits, and how they go about investing, followed by highlighting what is the best avenue to take, what's the best step to take in order to achieve financial success. This is called the financial life cycle. I'm just going to take a little step back so that you can see it. And just to give you a little bit of a highlight, on the left-hand side, the y-axis is basically income. And basically the dollar sign represents a little bit of income, $2 signs means more income and so forth. And on the x-axis is age. So you've got from age 0 until 80, okay? And basically, what it's trying to highlight to you is that from between the ages of 0 and 25, obviously birth, you're a child, you're a teenage, you're in the university age, you're not earning any income at that certain point in time. In fact, if anything else, you're costing your family money, you're costing your parents money. It isn't really typically until you get to age 25 you start generating revenue and you start working. And of course, this doesn't apply to everyone, but this is just on average, most individuals tend to follow this journey. There's also certain milestones that you go through at that stage of life. Between the ages of 20 and 30, you're a recent grad, you most likely will have some level of debt, whether it be school debt or it might be debt that you incurred from buying a car or financing a car, or it might be maybe you haven't learned about money management habits as yet, so you have credit card balances that are being carried forward month after month. You're also much more focused on career progression and personal development at that stage in your life. So social and recreational activities, vacations with your friends, a car. And you'll see that this repeats itself quite often, buying a car at different stages of your life. And also maybe towards the latter half of your 20s, maybe thinking about marriage. If not thinking about it, maybe being pressured into it at some point in time. It isn't until you get to your 30s where you actually are entering the accumulation phase of your life. Because at that stage of your life, you have a little bit more seniority. You have a little bit more career progression that you're experiencing. You start becoming a little bit more of an authority in your topic or in the subject that you've learned or in your work field, whatever it might be. So you start enjoying increased income. Increased income means you have more disposable income. The conversations that started off as maybe thinking about getting married, you're already married, now you're thinking about having children. And having children means now you have to start planning for childcare and, of course, vacations because you work hard, but you also have to play hard. You have to reward yourself. Lifestyle creep is also something you typically experience between the ages of 30 and 40. And lifestyle creep is, in a sense, the things that you used to enjoy before no longer meet your level of satisfaction. Instead of, say, McDonald's, it might be something a little bit more fancier, right? Instead of buying, a car that might just get you from point A to point B, you want to buy a car that's going to get you from point A to point B in style. There's a natural lifestyle creep that happens because you're making more money at this stage of your life. When you get closer to the latter stages of that accumulation period, more seniority, increased income again. I forgot to mention, you'd likely have purchased a house between the ages of 30 and 40, and of course, the mortgage payments that follow through. The children that you had in your early 30s might now be at a stage of being able to go to university. And of course, there's the financial pressures that come along with that, where you want to subsidize your child's education needs. That's a consideration. That's what typically a lot of individuals go through at this stage in life. I know there's a number of individuals I've spoken to here, I've spoken to in the past, who are approaching that milestone in their lives right now. When you get to the stage of between ages 50 and 60, these are your prime earning years. That's your peak. You are most likely a subject matter expert in your field. You're most likely the most senior, you would have been in your career at that point in time. Your mortgage most likely is finished because you may have taken a 20 to 25 year term. So your mortgage will probably finish by that point in time. You may be an empty nester. So the same children that you were caring for are now young adults, and they've decided to maybe take job opportunities in different parts of the world or just decided to move out. And there might also be consideration about tertiary dependence, meaning your parents. Your parents are also aging at this stage in life, and you might have to look after them. These are typical milestones most individuals get to, and all throughout that time, you're earning more and earning more in your hopes of getting to the stage of retirement so that you accumulate enough to be able to enjoy your golden years. This is a typical financial life cycle. It seems simple enough, right? Like very straightforward. There's nothing complicated about it. The challenge is that line is under pressure. It's under pressure due to things such as inflation. Inflation is that silent pickpocket that's always taking money out of your pocket without you realizing it or not. Every year, things cost a little bit more. So your purchasing power is being diminished year after year without realizing it. Suppose you have $1,000 today. You left that aside. That $1,000 will give you the purchasing power of $780 in 10 years' time. You've basically essentially lost $270 in purchasing power during that period of time. That's kind of like up in the air, pie in the sky. But let's talk about real things that people endeavor to acquire in their lifetime. Homes, a house today valued at $650,000. That same home 10 years from now, at just a growth rate of 2.5%, will then be worth $873,546. Same thing with education. You aspire to pay for your child's education 10, 15 years from now, but the value of what it costs at that time will be very different than what it costs today. Same thing with just basic cost of living. If $5,000 a month is more than sufficient for you to enjoy the quality of life today, $5,000 won't be enough in 20 years' time. You have to find a way to combat the effects of inflation. So that financial life cycle that I showed you in the previous example would be very challenging to achieve all those different milestones. So how do you do that? Well, very simply, and why where most of us are here today, is that you invest. You invest, you put your money to work at the end of the day. And there's no greater investment, in our opinion, than investing in the stock market. The stock market has been the greatest source of wealth for retail investors in comparison to many different asset classes that you could be investing in. And why is that? Well, fundamentally, investing in the stock market will allow you to benefit from capital appreciation, meaning you purchase the stock at a particular price in hopes that it's going to increase in value over time. And dividends. You receive income from these publicly listed companies who reward you for holding onto their shares. The combination of capital appreciation plus reinvesting your dividends helps you generate wealth over the long term. Now, over the last, I would say, what are we now? November, so 11 months, it's been a difficult year. It's been a challenging year, also on the back of a very difficult couple of years that we had, or when we had October 2020, where we saw the market under pressure. We saw negative results in our portfolios. And so a lot of individuals tend to equate investing with risk, just right off the bat. I want to invest, but there's risk. It's because they keep on being reminded about these events in 2008 when the market dropped by 50%, or in 2020 during the COVID pandemic where the market dropped by 35% on average. So people worry and they're concerned, and they tend to just focus on one thing, which is the returns. So people equate investing with returns. I'm investing so I can get returns. But very rarely do people focus on the things that actually matter to help you enhance your returns. If I stare at this microphone forever, I'm not going to be able to make it float. There's no other way. It's the same way as us looking at our statements and constantly looking at the returns in hopes that it's going to make an impact and assume that it's going to increase that value for you. The reality is there are things that you can do to enhance your portfolio returns and things that you can control. The things that you can control: time. You can control when you will start with your investment. You can control how long you're going to invest. You can control how often you're going to invest. You can control the risk. Whenever you have an investment solution shared with you, there's usually a menu of different risk profiles that will be able to suit your needs depending on the goals that you have. There's also other ways that you can manage risk through diversification. You've heard the term, don't put all of your eggs in one basket. Cost. People don't pay attention to the incremental differences in costs across different investment solutions. If one product is charging you 3%, but a similar product is charging you 1%, why pay more? Why pay 3 times more? Are you going to get 3 times the results? These are things that you can control, including the last option, which is behavior. You can control your emotions. You can control how you react to market volatility. These 4 variables are what will allow you to enhance your returns. Focusing just on returns, in which we have no control on whatsoever, does not generate better results for you. Focusing on these 4 areas will. So Let's talk about investors' experience. So we have four personas here, and if any of these faces seem familiar to you, they're people that work with us, so the images, are not of our clients. So what we did was we did a cross section of our clients, the ones that we speak to every single day, and we identified the challenges that they experience and their experiences and the outcomes. So there's some assumptions here, right? Everyone here is 25 years old. Everyone here is planning on retiring by age 60. Everyone, to some shape or form, is either investing or saving at least 20% of their monthly salary. Starting salary for these 25-year-olds is 75,000 US dollars. Again, all of them are saving and started saving at age 25. They receive promotions throughout their financial life cycle at ages 30, 40, and 15, in which they had salary raises of 20%. Now, for those who've gone through negotiations and whatnot, typically 20% is what most individuals aspire to achieve as far as a salary raise, which is considered a great salary raise. So we use that as a benchmark here. Inflation that impacts everyone equally is 3%. Investment costs are 1%. Savings account rates are 1%, and life expectancy all across the board is age 85. I know it seems like a lot to remember, but don't worry, this will make sense in a bit. Everyone will enjoy a growth rate of 6.5%, and everybody here wants a comfortable retirement for their golden years. Well, let's look at Robin, who's our first example. Robin is 25 years old, has just never prioritized investing, has been a really great saver. It's actually something that he learned from his parents, he learned from his uncles and aunts, where you need to put money away for a rainy day. 20% like clockwork every single month, to which he follows to a T. But what Robin does not do is put that money to work. He actually just leaves it idle sitting in a savings account because he believes cash is king. Let me leave this money sitting idle because an opportunity might present itself and I'm going to jump on top of this opportunity. Again, he wants to retire by age 60. And at that stage of his life, when he's 60 years old, he wants to at least have 40% of what he was most recently earning. If you look at the chart on the right, what we did was we basically said, okay, you start at age 25 with $75,000 and you receive a 3% cost of living increase every single year right up until the age of 60. You get that 20% raise. And in each and every situation, Robin is constantly paying himself 20% every month. Well, the outcome for Robin is that he's able to amass a savings balance of $1.6 million, which is a very nice number, very healthy, very decent. But at $1.6 million and requirement of $145,000 per annum, that'll give Robin the runway up until age 71. If life expectancy at the very least is expected to be 85, what will Robin do between that stage and 85 years old? Will he rely on his children? Will he sell maybe his primary residence, his home? Will he go on social assistance? What will Robin do at that stage in time? The point is that by not investing, by just sitting in cash and constantly accumulating cash at a growth rate of 1%, which is on historically, that's what you're looking at from a savings rate perspective, you have a shortfall. And my apologies, age 73 is what he's able to achieve. There's a huge opportunity cost because had he invested, he would be able to grow his money at a much faster rate than leaving the money sitting idle in a savings account. And just to kind of illustrate this example, there's a gentleman by the name of Jad and a gentleman by the name of Kareem. And what this video is supposed to illustrate is that Kareem and Jad, they both invest $5,000 a year, but Jad started 10 years earlier. And just by the simple fact of investing at a sooner stage, he's able to actually accumulate a lot more in net worth. That, my friends, is the importance of starting early, but also investing early. I'm going to hand it over now to my colleague, Mark, who's going to share with you the investing experience of an individual named Haneen.
Thank you, Ayman. So, contrary to the first type of investor, Haneen decided to invest that 20% instead of saving it in a bank. But Haneen, since her early days, she's been told gold is the safest type of investing. It's steady. It's something that you can make a decent return over the long term, and it's a good hedge against inflation. So what we did here is we kind of illustrated what that would look like over her work life up until the end. So that 20% invested in gold, we assume that it grew alongside inflation at 3%. And she retires by the age of 60, similar type of income as Robin, so inflation adjusted, and she wants to maintain that lifestyle post retirement. So this is why we're considering that 40% share post retirement. So contrary to the 1.6 we've seen with Robin, Haneen managed to grow that further to around 1.9 million. Same three raises at the age of 30, 40, and 50. So by comparing it very quickly to the previous chart, we can see that Haneen managed to extend that runway by a few years. And that's basically because she managed to benefit from that extra growth in investing in gold rather than just keeping it in a savings account. Now, there are good things that Haneen did, but there are also considerations that we need to take into account. So things that Haneen did well, basically she manages to achieve her financial milestones throughout. So if she wants to buy a car, she wants to buy a house, send her kids to school, so everything was able to be accomplished. Furthermore, she managed to approach her finances with a good structured budgeting method. So here we took into consideration the 50-30-20 rule. If you've ever heard of it, basically it's one of the many frameworks out there that we use. 50% would be basically for your needs, 30% allocated to your wants, and the 20% which we've talked about that she's invested in gold. So what she manages to do is be disciplined, be consistent, and she manages to put that 20% throughout her working life and manage to have a nest egg for retirement, which we refer to as the 1.9 million. Now, what are some considerations we need to take in that case? Number one, she invested only in gold. And she did that because she was told that it's a good investment. So it was, let's say, her comfort zone in that sense. This is what we call the familiarity bias, in the sense that she only invested in what she was familiar with or what she knew about. Now, although we recommend clients to kind of invest in things they believe in, things they're comfortable with, but we don't want them to limit themselves to that only. So this is where the importance of diversification comes in, which I'll highlight in a bit. And she manages to push that shortfall by a few years, although she would still need to take some measures, as Eamon mentioned, to kind of satisfy her lifestyle up until the age of 85. So here, the purpose is to kind of highlight the importance of diversification, especially over a long period of time. Now, here at Sarwa, we believe that diversification or proper diversification is not an obstacle to achieve proper returns or proper growth. And effectively, we believe that with proper diversification, you can increase your returns while minimizing your risk. So by looking at the graphic on the left on my right-hand side, basically we can see over the past 5 years, in terms of asset classes, the top performer is different each and every year. So by kind of focusing only on one asset class, although we might hit it a few times over a long time span and be invested in the best asset class, we'll most definitely be missing out on great returns. And this comes at a detriment, of course, over a long period of time. If you were to focus on geographic market, we can see that the top performer most often than not is different. And the distribution in both sides is very random. So there's no pattern, there's no trend. And basically diversification allows you to gain exposure, spread your eggs in different baskets, and kind of benefit from best performing asset classes over the long term. Now, the third type of investor that we would want to highlight is Manny. Manny has, contrary to Haneen, decided to go with a well-diversified portfolio. So Manny has a curious eye. He saw his father invest in a globally diversified portfolio since his young age and decided to do the same once he started to work. So Manny called up his dad's advisor. He inherited kind of the relationship with them, but he inherited also his fees. And this is where we want to highlight that here, instead of the 1% that Hanin used to pay, for example, Manny was paying 3% instead. So 3 times the amount. So by looking at that chart, we can see that the growth is much more significant. So instead of the 1.9 we've seen with Hanin, Manny managed to achieve 2.7 million instead. Similar conditions, same salary, same raises, and so on. And what's important to highlight is the runway. So you can see the runway is closer to 80 in that case. So he managed this to push it by around 6 years just by investing in a globally diversified portfolio. We assume the growth rate of 6.5% in that case, which has over the long term shown to be a conservative kind of estimate for global growth for financial markets. So what did Manny do well? Well, similar to Hanin and Robin, managed to achieve their financial milestones. He was consistent, disciplined, following structured budgeting rule, and he diversified his investments as well. So pretty good. Now, the purpose of this example is to highlight the cost of fees, or what can charges do, and their impact on your growth. Although it was a very decent number that we've seen, kind of controlling your growth can allow you to achieve higher growth. And this is what we want to highlight here. So instead of the benchmark that we tend to use around 1%, Manny here was paying 3%. So good returns, but the shortfall was still there. So looking over the long term, right, one can think 1%, 3%, what's the big deal, right? But if you tend to illustrate it, you would see that it's quite significant. So this graph kind of illustrates two things. It illustrates, first of all, if you look at the your right-hand side and focus on the red chart, the red line, sorry, you can see the annual difference in fees that someone would be incurring if they're paying 3% instead of 1%. And if you were to focus towards the end of the working life, so around 60, that amount would be around $80,000 per year. If we were to look at it from a cumulative basis, and this is where it gets interesting, that reaches almost $870,000 in fees. Imagine that. You're getting the same service as your neighbor, but you're paying almost $900,000 more. It's kind of interesting, I guess. So imagine if you were kind of to optimize for all this, right? So there's considerations to take, as Eamon mentioned, in regards to things we can control versus the things we can't control. So very important to kind of highlight this. So now our colleague Faisal will be talking about the fourth type of investor and kind of highlight basically his journey in that sense. Thanks.
Hello, everyone. My name is Faisal. I'm part of the advisory team here at Sarwa. And for the last 5 years, I've been working within the fintech space in Saudi and UAE. I've been with Sarwa for almost a year now, and it's been a great journey thus far, helping investors achieve their financial goals. I wanted to be there with you all in person today, but sadly I could not, so digital me will have to suffice for now. So for our fourth investor experience, we have Sadi. Sadi, much like our other investors, is 25 years old. He started investing early and invests in a diversified portfolio. Sadi invests 20% of his monthly income, and similar to our other investors, increases his contributions as his salary increases. He plans to retire by age 60 and live off of his investments. Sadi is aware that high expense ratios eat into his earnings, so he decides to utilize a service that charges less than 1% per annum. Sadi's investments are geared towards success. However, he tries to time the market as a result of his anxiety. When markets are volatile, Sadi changes his risk profile, often in anticipation of market movements, has exited and re-entered the market a number of times. As you can see on the graph, where the green vertical lines are, Sadi has exited the market at age 31, 36, 42, 45, and so on. Each of those times, he's withdrawn to cash and has earned an assumed 1% interest for being out of the market. At the ages of 29, 34, 40, 48, and 58, Saudi has changed his risk profile from growth to conservative, which are depicted by the orange vertical line. Again, we assume the 1% growth rate on his conservative investment. We're giving Saudi the benefit of the doubt here. He hasn't been exposed to the downside. We assume that he exits the market and back in without any capital loss. And based on Saudi's chosen investment path, his investment will carry him through up till the age of 77, which is not sufficient to carry him through the average life expectancy. Now, what went well for Saudi and what didn't? Saudi was able to live a rich life and experience all the major and common milestones like buying a house and sending his kids to school. He was able to put forth a budget, stick to it throughout his working years, and consistently invested 20% of his monthly income. His portfolio was well diversified and kept fees lower than 1% per annum. Now, what didn't go well for Saudi is that he tried to time the market and attempted to capitalize on market swings, which we'll see later that time in the market more often than not beats timing the market. Saudi often changed his risk profile during periods of volatility, which resulted in selling equity in favor of fixed income assets. Although in Saudi's case, we never factored in potential losses, in reality, most of us are not great at timing the market and will make losses during such actions. In this case, most of us would crystallize losses and prevent our portfolios from fully benefiting from market recovery once it came about. As we mentioned in the previous slide, his investments carried him through till the age of 77, causing a retirement shortfall, meaning Saudi would have to rely on external sources of income like his children or sell some assets like his house to carry him through to the remainder of his life. Not ideal for a person at this stage of his life. Instead of enjoying his retirement on Thumb Beach, Saudi has to worry about securing additional resources to meet his living expenses. The anxiety and pressures associated with trying to time the market have caused Saudi undue stress and unnecessary panic. Now we'll take a look at two studies that show that time in the market is a strategy that almost always beats timing the market. In the first graph to the left, we can see that a portfolio that adopts a buy and hold strategy of an S&P 500 index tracker between the periods of December 31st, 1989 and December 31st, 2021. The first bar on the left has accumulated an average return of 10.8%, and the bar to the immediate right shows that if an investor chooses to time the market and only misses out on the 5 best days, the average returns drop down to 10.2%. And if 10 days were missed, returns drop down to 8.1%, all the way to 5.6 if the best 25 days are missed. In short, staying invested is the best way to ensure you don't miss out on the best days. Now, the graph on the right is a study that was conducted by Morningstar. It looked into the returns of a given fund over a period of time that simply adopted a buy and hold strategy. And on the right, we see the investors' performance with that same fund, but investors bought and sold at different time intervals to try and anticipate the market. So the gap shows that had they simply stayed the course, waited out the volatility, their portfolios would have been in a much better position, as opposed to trying to capitalize on the volatility. People that try to time the market or act on downtrends in the market oftentimes end up making less than what they would have had they just stayed the course and waited out the volatility. Panic selling is arguably the worst form of emotional impulse that often leads to major losses. Now I'm going to hand it over to Akshay, who will take you through the habits of a successful investor.
Perfect. So we've, ultimately just gone over 4 different personas. We've spoken about Robin, who never invested any money at all. We then spoke about Haneen, who had basically only invested in gold, never diversified. We then moved over to Manny. Manny had some pretty expensive investment fees. And then finally, we spoke about Sari, who basically was a very emotional investor. So I think I've actually got the easy job. I get to speak about Zain. And Zain is actually our ideal client. Zain is 25 years old, very similar circumstances as the other 4 people. Same income, same sort of expenditure, is still looking to achieve the same lifestyle and retirement goals at the end of her life. But the main difference between Zain, I guess the other four that we were talking about before, is that Zain was taught the importance of investing early. This was something that was drilled into her, from a very early age. And from the time that she graduated university, she was basically investing on a monthly basis without fail until she ultimately retired. She also understood that diversification is extremely important. She made sure to buy into a globally diversified portfolio, covering a variety of different sectors, asset classes, as well as geographies. She also, talking about it before, made sure that she had a budget in line, always made sure that she invested on a monthly basis. And very importantly, she also made sure to keep her expenses low. We were talking about Manny before, who had 3%. Zain, like the other three, kept her expenses low to just 1%. And very importantly, she really followed the principle about time in the market as opposed to timing the market. Zain was a very unemotional investor. No matter if the market was up, if it was down, she continuously had a plan and stuck to it on that monthly basis. And the way she was able to do that was by focusing on her goals. She had a financial plan in place and made sure to follow them. So I'll just quickly go over what went well, in these circumstances for Zain. So Zain really focused on what she could control, right? By basically investing early, by diversifying her assets, by keeping her costs low, by managing her emotions, she was able to really reap a reward by the end of her life, right? She achieved that financial goal of a well-funded retirement at age 85, right? So I think we've got it on this slide over here, right? By the time that she turned 60, she had a retirement portfolio of over $3.6 million. That is significantly more than the other circumstances, the other personas that we looked at before. And that also meant that she was able to actually, end her life at age 85 with, substantial income. She had that passive income, every single year from age 60 until age 85 of $145,000. And, that really means that she was able to achieve every single major milestone that the others were able to too. But not only that, she was able to do it until age 85. So this slide over here, really simply put, I know we've been talking about quite a few different personas. It's just highlighting exactly, the difference between all of them, right? And what I want to do is just highlight the main difference between Zain, who is, our model investor, compared to, let's say, Robin, right? So Robin, he actually never invested at all. So that meant that, he actually ran out of money around, in his early 70s, around age 73. Zain, on the other hand, age 85. It's a huge difference just by investing. We're going to go over to Haneen, right? Haneen basically only invested in gold. That was her flaw. She had a little bit more years on the line after, a little bit more than Robin, but still quite significantly less than Zain. We're looking at over 10 years, right? Then we go over to Sari, who had everything in place, right? He had the right investment costs. He had the right diversification tools. He had basically started very early as well. Sari's pitfall was that he got nervous, he panic sold, he, got into the market, he got out of it, he changed his risk profile. Zain never did that. And as a result of that, we're looking at Sari getting to around age 70, I want to say 76, 77, and Zain at 85. And then finally, basically the person who got closest to Zain was Manny. He did everything as well that he was supposed to. Main issue was all about his fees. And just by paying that 3% as opposed to 1%, Zain has roughly around 6 more years of retirement than Manny. Oh yeah. Perfect. So guys, that was ultimately our 5 different personas. But really just to drill it down, I want to, really just highlight the importance of these 4 things that everyone was trying to achieve. Right? So, myself, Eamon, Mark, Faisal, we speak to clients on a daily basis. Everyone has their own sort of concerns about how they're going to achieve their financial success, their financial freedom, for retirement or for whatever goal they're trying to achieve. And by following these 4 things, we really believe that you can ultimately achieve those goals, right? So we talked about, with number 1, start to invest early. A lot of people in this room are here because they already do invest. But for a lot of people who maybe don't invest at this point in time, starting to invest is always the most challenging part. It's really important to understand why are you going to invest it? Think about your goals, think about your objectives. And once you've done that, a very crucial thing is to establish an emergency reserve. We always say that emergency reserve should be around 3 to 6 months. The reason for that is you don't want to have to dip into your investment portfolio um, in case you have a big emergency. So if you've got your emergency reserve set aside, the next thing you want to do is focus on paying off any debt. It says any debt here, but what we want to emphasize is any high interest debt. High interest debt like credit cards or high interest loans. These things are important to pay off because if you're investing at the same time, that that loan provider, that credit card company, they're no matter what they're getting there, 48% per year as a default. In order for you to really capitalize on your investments, it's important to make sure that you pay off those debts and then you can focus on the investing. So once you've done that, you've got, you basically have the tools to start. What you want to do is start with a lump sum, right? Whatever money that's beyond that 6 month worth of emergency reserve, whatever money that's beyond your sort of near term budget, start with a lump sum. But what's even more important than that is investing on a monthly basis. The reason for that is it's the easiest way. If you get paid on a monthly basis, you can set up yourself with an investment plan. It's very unemotional. The money comes in, regardless if the market's up, if it's down, you're going to invest every single month. And if you can do that consistently with a disciplined approach, by the time you're age 60, hopefully you can be like Zain. You can live out till age 85 and be very comfortable. So that's number one, with the importance of starting early. Number two is diversification. So in the scenario we spoke about Haneen. Haneen only invested in gold. And what you want to do as an investor is try to spread out your eggs in multiple different baskets into hopefully negatively correlating assets. And one of the, if you want to do that, you want to make sure that you have exposure to every single major sector in the world, every single major geography, every single major asset class. We're talking about fixed income, we're talking about equities, we're talking about real estate, commodities, all of these different things. But also you want to go even further, diversify from a sector standpoint. Information technology companies, financial services companies, healthcare, consumer staples, the list goes on. And you want to do it from basically a geographic perspective also. Give yourself exposure to the emerging markets, foreign developed markets, and the US market. One of the easy ways that you can do that is by investing in something called an ETF. An ETF is basically a basket of different stocks and securities all bundled up into one. And it's a really easy way to achieve, portfolio diversification. So we've got that as number two. Number three, you want to keep your investment costs low. As we talked about before, your investment costs are ultimately eating into your profits. They're eating into your portfolio value. So try to make sure that you can use 1% as a benchmark. If you can do lower, even better, right? And then last but not least, with our sort of fourth rule as per se, it's all about managing your expectations, managing your emotions, and controlling your emotions. As individuals, as human beings, it is the easiest thing to do is react to news, to react to what people are saying, your friends, your family, what you hear on CNN or MSNBC or whatever it might be. Try to avoid that. Think about why you started investing in the first place. Focus on your goals, focus on your objectives, and really think about, if what is that plan that you had in place, and try your best to stick to it. If you ever have concerns and if you ever have questions about it, try to speak to a financial advisor. The whole point about, an advisory service in itself is behavioral coaching is a huge part. If you have issues about where the market is at this point in time, if you want to know whether it's a good time to invest or if it's a bad time to invest or whatever it might be, have a conversation with somebody because you might not be alone. A lot of people will be thinking the same thing as you. And with that being said, I think we've spoken quite a lot. I'd love to open it up to Q&A. So if anyone has any questions, please let us know.
We will be sticking around afterwards if anybody wants to have any private discussions or any questions. But again, if you have any questions, please feel free. We're more than happy to address them for everyone.
Yeah.
Hi. Yeah. As a person who's 26 right now, like it's hard to choose which stocks to buy. Like, how do you differ a dividend stock versus a growth stock? And for a person my age, what would you advise me to focus on?
That's a really great question. So first, I envy you being 26. I wish I can take some of that energy, because the whole world's ahead of you. Really, at the end of the day, you have so much opportunities, and you're having the right questions being posed at this stage. You're thinking about the right things. You're thinking about how to ensure your financial success in the future. So you have a benefit, which is you have a very long time horizon ahead of you. Being 26, we talked about it. We used examples of being 25, and that's best case scenario. Many of us didn't start at that stage, right? So you have time. That's in your favor. Now, when it comes to the question as far as what should you be investing in, it is very difficult to pick and choose the right stocks, flat out. There are some people who might have a knack for it. There are some people who have the capacity and they're willing to spend the time and energy and focus to make that their primary objective of picking the right set of stocks. And even then, it only gives them a chance of winning. It doesn't guarantee. It's very difficult to pick winning stocks consistently. So a great approach would be to diversify and use an ETF or a number of ETFs that will give you great diversification across many different geographic regions and also different sectors and different asset classes. Because if you remember the slide that Mark was covering earlier about diversification and the randomness of returns, every year is different. And the best way to manage your risk and still enhance your returns is diversifying, and an ETF does a really great job. Secondly, dividends versus growth. Are you looking to grow your portfolio at this stage of your life? Or are you looking to generate passive income from the portfolio that you have at this point in your life? To grow. And why do you want it to grow? Right? But you want it to grow for a purpose of growing your compounding. Thank you. Dividends are great and they're essential. And that's one of the benefits of investing in capital markets is that you'll receive dividends. But taking an approach of a dividend focus and growth secondary means that there's an opportunity cost here. What you ideally want to achieve is growth. And when you get to that stage in your life when you need income, is when you start looking at maybe modifying or adjusting your portfolio so that it's more of an income generation or generating portfolio, right? Now, I don't want to say this as a blanket advice to everyone because for everybody's situation is different, right? There are some individuals who get to the age of 60, they still want growth because they're thinking about inheritance at this stage in their life. They're thinking about foundational wealth that they want to pass on to the next generation. So there's different goals and objectives for everyone. But typically, what you aspire to at this stage of your life is grow your portfolio. So you get to the stage where you generate income and you'll start making some amendments and portfolio adjustments to generate a higher level of income, which is predominantly dividends at that point. Hope that answered your question. Anyone else? Yes, sir. All right.
My question is more about protection. It says you are regulated by EFSA. Where are these funds? What's the vessel that's holding these ETFs? Where are they? What happens if you guys go bust? What protection does the consumer have?
Perfect. Thank you for that. Regulations matter. And if you've been following the news as of late, this is what happens when you don't have oversight and when you don't have regulations. And of course, anybody's probably been seeing the headlines of FTX and Sam something Friedman. What's his Fried Bank? Take your money, guy. Okay, yeah. We are duly regulated, and this is important. So we're regulated by the Dubai Financial Services Authority, which is housed within the DIFC. We're also regulated by the Financial Services Regulatory Authority, which is Abu Dhabi Global Markets. To do what we do, the responsibility that we have for clients, you need to operate in a regulatory environment in which it protects investors. You cannot just open a trade license, call it consultancy, advisory, and operate in what we do. There are checks and balances in place. There's a segregation of your assets and clients' assets. Your assets and our assets. There's a flow, there's audit, there's oversight on every step of the way. Between those doors and that, at the end of the day, these are all fintech companies who all either operate in financial services or payment services in some shape or form. They're all regulated by either the DFSA or FSRA. There are billions of dollars being exchanged from door to door here of clients' assets. And if you go a little bit further down, where you have the likes of the JP Morgans and the Credit Suisse and whatnot, who also have the same licenses, it adds up to be even trillions. You can't operate here if you don't have the right checks and balances in place for clients. And that's how we operate.
I think I'll also just add to what you were saying. Going a little bit further, then obviously this is the regulatory environment that we're in. But we also choose to partner with reputable brokers. So Saxo Bank for our Sarwa Invest product, and basically Alpaca Markets for Sarwa Trade. And then we also use custodian banks. So Citibank, for example, for Sarwa Invest. So these are just other, basically another set of guardrails to make sure that your assets are safe as clients. So, it's basically Sarwa, the assets are segregated, but then we also use, Saxo Bank, Citibank to make sure that the assets are safeguarded. And then we also work with, some of the biggest asset managers in the world, BlackRock, Vanguard. Each of these asset managers manage trillions of dollars. So it's also just another sort of level to make sure that you, as a client, your assets are ultimately kept safe. Any other questions? Yeah.
Hi. You just mentioned that you are regulated and Saxo Bank is there who is the custodian. When I started, IB was the only broker, and it had some kind of regulatory SIC or something like that. $500,000 is protected. Yeah. Whereas when I call IB, I know I am their customer. I can withdraw in my account. Same thing I tried doing with Saxo. They don't know me. Who are you? So I mean, kind of peace of mind I had with IB, I don't have with Saxo.
Yeah, that's a good point. That's a different structure that we have, and we have developed with Sarwa X, which is the one that's related with Saxo Bank, basically. So the way it works is that with Saxo Bank, there's a corporate account that's under our name, right? And on our ledgers, basically, we have a list of accounts, the one that you see on your dashboard, for example. And that account is basically a sub account under our corporate broker account. So ultimately, we know that you are the owner of that account. The regulators would know that as well for multiple reasons. One of the most important one being that whenever you register, if you recall, you would upload your documents, you would upload your picture, your information, and your account number is unique. So we know that, for example, Akshay is the unique account owner of account number 123, right? So the reason we did that is for there are multiple reasons we did that. Number one is to kind of facilitate the funding flow, so you can fund an AD, you can save your bank fees, it's more tech enabled. Number two is to kind of shield you from what we call inheritance tax or estate tax, which is applicable for your IB account if it's above $60,000. But for your Saxo or your Sarwa X account, this is not applicable because it's a corporate broker account. So this is kind of a structure we kind of adopted. It has the same type of guardrails. It might not have the same type of insurance, but it falls under the regulations of both the DIFC here, ADGM, and our broker in Europe, which is in Denmark, which typically have the highest standards of regulations. So although we look kind of fun and we're young, but we do take security of your funds, in the most serious way. So hope this answers your question. Partially.
Hi. Just want to ask you, like, if you have invested for 5 years slowly, SIP, and then you don't have a nominee in your account, and suddenly if you die, what happens with the money?
Yeah, that's. Can you hear me? Yeah. Okay. Yeah, when we're looking at, so basically, if you've been investing for a long time and obviously you pass away, what happens next? So we've actually implemented something new at Sarwa called a wealth beneficiary option. So you can actually add a beneficiary to your account. So otherwise, historically, it'll go according to the laws of kind of the land. So what you can do is you can add a beneficiary, a wealth beneficiary. So those are the people that are going to ultimately succeed the account. So when you pass away, it'll be passed over to this person. Is that, yeah? So yeah, so we actually charge it's about $50 to add a beneficiary onto the Sarwa X account. Yeah, perfect.
Okay, it's question again. It's regarding the security of the fund, right? So as you explained that we have a specific account in the Sarwa, right? And it is owned by any. If I have Sarwa account, it's owned by me. So Sarwa knows it. So let's say if Sarwa is not there, and what is the direct relation? If let's say on my behalf, Sarwa has purchased some stocks like in Apple, Amazon, or something like this. Yeah. But what direct relation I have with the Apple and Amazon? Although my money is invested, but they don't know me, and Sarwa is gone. So how?
Well, so it's not possible for Sarwa to be gone without you receiving your assets, because there's a step-by-step process and a protocol that happens, right? So let's just say we decide that we would like to exit from the business. We no longer want to operate in what we do. Our first responsibility is that we have to reach out to all of our clients and say, look, we're exiting from the business. Withdraw your funds, transfer it to another broker. You decide what you'd like to do. Now, that's assuming that we proactively said that we want to exit. Let's look at worst case scenario where the doors shut last minute. Keep in mind, the assets themselves, they are segregated from us. We can't just simply withdraw them. In fact, the way that our operation system has been built is that you are the only individual who has the ability to make withdrawals from the account. If we need to make withdrawals, there's a process that we have to go through where we have to inform the regulator what's the purpose of the withdrawal. We can't simply do that. If we were to shut our doors, the regulator would step in at that point in time and go through the general ledgers to identify who's the account holder, what's their contact details, and they would be reaching out to you. That's assuming if we shut our doors not by our design, is what I'm trying to say. So at the end of the day, how to explain this, there's always a step one way or another that if you would like to access your withdrawals or whatnot, you can do it yourself at any point in time, even if we shut our doors, or you can go through the regulator.
Okay, so in this case, then we, as a customer, I don't have direct relation with any company, right?
Well, no, because at the end of the day, your relationship is sorry.
Sarwa is the one who is holding the fund, and on my behalf, Sarwa is buying the shares, right?
Correct.
But and companies know Sarwa. As a Apple knows that Sarwa has an account and Sarwa bought some shares from the customer fund, right?
Actually, Apple would never know who you are
Whatever
really
the
at the end of
company
the day, right? So
the shares, right? So
right.
whatever the company. So I don't have direct relation with that company. Like for example, I come from India, so
Yeah.
I can buy directly share in, let's say, a famous company, the Tata, Wipro, right? So they know if I'm buying a share, they know me. That so I don't care about my broker. There are n number of brokers.
Right.
Although I bought the share from the broker, but there is no any dependency of the brokers. Tomorrow, if the broker is gone, I have direct relation with the company, Tata, Wipro. I can approach them and I can take my fund from them. So this case is not with the Sarwa.
No, so assuming this is a publicly listed company that you purchased shares in, you wouldn't just directly approach Microsoft and say, hey, I own shares of your company and I want it back. You need to sell them in order to receive the proceeds, right? At the end of the day, because your asset is the shares themselves, to which you need a broker at the end of the day. So if you go approach Microsoft, say, hey, I'm a shareholder, they'll say, okay, thank you very much. Great to know. But you couldn't just sell your shares in Microsoft without utilizing a broker, because you need a buyer for every seller. Now, what we use is Saxo Bank. That's our engine. That's our platform that we use to basically purchase ETFs on your behalf. Now, when you purchase these ETFs, they don't sit with Sarwa. They don't sit with Saxo Bank. They actually sit with a third-party custodian, which is Citibank. And that's there because in the event of Saxo Bank should default or even Sarwa should default, it makes no impact to you whatsoever. That sits with the custodian. Who's the owner of these assets? That's you. You're the UBO. Now, for as long as we're here, you can literally simply withdraw, contact us, and we can help you on how to withdraw. If for any reason we are not in the picture because we've closed our doors, keep in mind it's a process. It's not, you can't just shut your doors overnight. There's capital deposits that we put in place with our regulator. There's a step-by-step. You can even look at our website, or even go look at the regulator website that shows you how to unwind the business. That includes reaching out to our clients and saying, look, you've got to basically withdraw the money and take the money out. That's the step-by-step process.
And one more question regarding this process of IB. Initially, I was having an account with IB. Then after that, I withdrew fund as advised by the Sarwa consultant. So I was having a separate login ID for the IB, and I used to log in and I used to check the fund and everything. I was having a direct relation with the IB,
Correct.
Sarwa was not involved in that.
Correct.
And, last time when I withdraw the fund, Sarwa said, okay, you directly contact with the IB and just withdraw your fund.
Correct.
But right now, it's not the case. And I don't have direct relation with this with Saxo Bank, right?
Correct.
Saxo Bank, I don't have any login. So I have to be dependent on the Sarwa.
Correct.
So
what's the question?
So no, I don't want any dependency, right? that was more secure, actually. The IB was more secure, I guess.
There's an illusion of security, is what you're getting there. Because when you had a direct relationship with IBKR, that means then you had a fractured relationship. You're working with us and you're working with them. You come to us for some things, you come to them for some other things. And that's where it was a fractured relationship where we're co-managing your relationship. What we did was we upgraded our license to be able to own the relationship end to end. And what that allowed us to do is that you have one point of contact. You can fund for free. You no longer have to send a telegraphic transfer to Interactive Brokers. You fund it directly to the account here in the UAE, and we do the telegraphic transfer for you. We're able to create more products and more solutions because IBKR just wasn't a great partner for us. Saxo Bank has been great. And we're allowed to plug in directly into Saxo Bank and create more solutions and more products. And that's how you've been able to have more solutions available to you. We've saved you more money, and we've also given you more products and solutions. And we've also upgraded our license to give you a greater level of security. If something had gone wrong with IBKR, we wouldn't even be able to help you. You would have to contact them. Pros and cons, I guess, in that perspective. But at the end of the day, that's been the direction where if you go to an organization or if you go to a bank, they utilize omnibus structure because it's much easier to manage relationships for clients, especially on scale. It's very difficult to do one-on-one fractured relationships that way. Well, happy to talk afterwards if you want. Okay.
Thank you.
Sorry. Any other questions, guys? Yes, sir. Yeah, we kept you waiting for a while.
Yeah, it's been a pretty cool session. I use Sarwa investing, and I wanted to know, like, you have like a bunch of different things, right? You have VTI, you have VNQ, and all these different things. So I wanted to know how your portfolio management team figures out, like, what is the percentage weightage should be on each of them. Like, why do you have, like, I think 3% on US real estate, and how do you figure that out? Do you do like quant thing, or I don't know, read the leaves? Like, how do you figure that stuff out?
Just so I make sure.
The investment methodology, the how did we come about the, sorry? Yeah. How did you come to decide on the weightage, the allocations, etc.?
Yeah, cool. So we have an internal investment team or department that basically we use a theory called modern portfolio theory. It's a very well-known theory. It won a Nobel Prize. You can Google it basically. And the idea behind it is, as we said, diversify, lower risk, increase return, right? So basically we have our own screening analysis methodology. We rely on that methodology as a foundation, but we build upon that with our own proprietary analysis and assessment to, first of all, assess within each geographic market or asset class what are the best investment options, and basically how to build a portfolio that's well diversified gives you an interesting risk return profile in that sense. The allocations themselves were a result of that analysis, and this is something we review on a quarterly basis. So every quarter, we relook at our analysis, at the updated numbers. Do we still believe the diversification benefits are there? Can they be optimized? Are there better solutions out there at the moment? Can we switch it up? And this is something, for example, we've done last year. So we had an emerging market ETF, which was IMG. We switched it up with VWO. We found that it's a better fit based on the overall portfolio, and that's how we tend to be proactive about it, basically.
Any other questions, guys?
Yes, thank you so much. So, since you are also having the crypto portfolio as well, this might be something out of the context perhaps, but from an investment standpoint, how do you see or how do you protect the investors against an FTX, which is very well known? That's been buzzing the entire market, right? So from Binance to FTX, that there is no repeat of an FTX, and how would the investors be protected against that?
Yeah, that's a really good question, and I think that's on the mind of a lot of people at this point in time. Look, just going back to it, Eamon mentioned the regulatory environment that we operate in. The DFSA, the FSRA. This is the number one protection that you have as a client. The regulators make sure, obviously, that it's not as simple as you can just buy into any crypto platform, and they check things such as the exchange requirements, the capital requirements, deposit insurances, a few other things like that. Like at the end of the day, when you are investing in crypto assets, they tend to be a lot more volatile. They tend to be, a little bit more. There's a little bit of in the assets themselves. There's a little bit more less of a regulatory environment. What we do at Sarwa as part of our crypto platform is we actually diversify the actual exchanges. Even our broker does that. So it's the assets are never just on one thing, such as FTX. It'll be on multiple different exchanges to ultimately not to make sure that we're not in a position as to what's happened at this point in time.
And I just wanted to add in there because we offer crypto portfolios on Sarwa Invest, and it's not an accident that we offer Bitcoin and only Bitcoin as a part of the Sarwa Invest portfolio. It's because of the thousands of cryptocurrencies that are available. There's much more information available about Bitcoin. We were able to do analysis, look at the historical returns, look at the how it operates in volatile environments, if there's correlation or no correlation whatsoever to the US dollar. There's a number of different things that we looked at, and that's by design that you have the ability to allocate up to 5% into Bitcoin exposure on your Sarwa Invest portfolio. But as Akshay said, cryptocurrency in itself is a very volatile asset whatsoever altogether. But in addition to that, from what we've seen, it's not just the cryptocurrency itself, but the environment in which the exchanges or the custodianship, all of this, it's still in the initial stages from what it looks like. And there needs to be, my personal opinion, and I think it's a shared opinion, is that we invite regulation when it comes to these things, because at least then it'll give consumers much more stability, much more confidence, and you won't see things that you've seen before with the FTXs and the Celsius and who knows maybe what else might be coming down the pipeline. You will not see that as much. The stock market is very different from the crypto market in itself, where you don't hear about these things. It's because it's had so much of a longevity, so much of a history, over 100 years of activity in which there's been trials and errors and perfecting it and security and making sure that investors are protected. Crypto is still in its infancy. So do I foresee that there's going to be more hiccups in the future? Potentially. But that also goes with the territory of risk and reward. Yeah.
Any other questions?
I think maybe we'll take our last one because we're approaching 7:30 now. So
sounds good.
Anyone? Last takers?
Last question.
Yes. Where's our CEO? He was around here somewhere. He can speak on it. Mark, you around? No? I can tell you the overall goal or we want to do is we want to be your one-stop shop at the end of the day. For anything you think of when it comes to finance, anything finance related, we want Sarwa to be top of mind. So when it comes to even your short-term liquidity, maybe your dividend requirements, when it comes to maybe card payments, it could be any number of different facilities, anything finance related, we want to be that company. I can't get into specifics at this stage because I don't want to be held accountable to it right now and the timelines, and plus product will kill me, so I can't mention those things. But that's our aspiration. We want to be the one-stop shop at the end of the day. Okay. Thank you, folks. It has been an amazing evening. Thank you for joining us.